Hi, this is Randy Finney with the right side of the chart, and this is an early session update for Tuesday, October 7th, 2025. Just wanted to kind of go through the charts, some of the things I'm watching. I'm going to start out here, as I often do, with the equity markets. Told you last week, I think this week will be one way or another the catalyst for reversal here, a breakdown. We're pinching into the apex of this wedge. This is the daily chart of QQQ. Here is the current primary uptrend line off the key April lows right there. And we just continue to diverge, meaning we continue to make lower lows on the indicators, the momentum indicators, and with higher high-end prices as we really pinch tight. So, I don't have to tell you that sentiment's as high as it's ever been. I've never seen so many analysts jumping on the bandwagon, calling for Dow 7,000, some crazy numbers. This is getting very close to what a top looks and feels like. Again, if you've done this a long time. And so while there is that, I talked a few weeks back, the potential for a blow-off top, at this point in time, I think too many are on board with that scenario for that to be the most likely scenario. So I put a very low probability on it. And again, the charts are the charts. Let's just watch these levels. This is the 60-minute chart I gave you here. We had an objective short entry on that breakdown there, and then I highlighted a second one there, but said no go above that line, the downtrend line. That's was and still is the no shorting zone. However, we still are waiting a major sell or the next swing sell signal objective entry or add-on to come below that line. So, but my point is we've drifted up enough now. We broke out. That was the downtrend line off the highs I was talking about right here. This is what, 2 weeks ago, a week ago? Right there, the downtrend line. We broke out, back tested. We've bounced enough now that if we come in and take out the trend line, I do believe and can tell you with a high degree of confidence that'll be an objective short entry. And that's it. So we're at all-time highs. There's no resistance, hence you're not seeing resistance levels there. We're just off all-time highs, I should say. So very nice setup. I still very much love the VIX. That's where I think the best RR is right now. If the indexes break down, yes, this is the NASDAQ 100. Yes, the VIX is based on the S&P 500, but the NASDAQ 100, as I often say, is just a concentrated view. It's like peering into the S&P 500 with a magnifier glass because it has the same holdings, just higher weightings, and those are the stocks that will make or break the market if they break down. So that's it. That's what it looks like there on the 60. We need to take out that trend line to trigger a sell signal and the next objective short entry add-on. And let's just glimpse at the SPY. The SPY has broken down the S&P 500 on the its comparable 60-minute uptrend line. Again, I'm zoomed in a little bit here. You can see the chart. We've been diverging for a while. Breakdown, back test, and what I like to see after a back test of a trend line, because the problem is you can continue to back test. Sometimes you take back the trend line, prices move back up. So you really want to see that rejection candle off there, and that will help. And then, of course, the comparable trend line I give you on QQQ. Yeah, VIX, you can look at the spot VIX. Spot VIX is, again, for quite some time now, continuing to make higher lows, holding above that trend line, and just needing this catalyst right here, that 1720 level I've given you. It was support back here, support, we broke it. Went through it a couple times, but lately, and that's the thing about any chart, the most recent reactions in my book carry the highest weighting, and we've had quite a few right there. Again, VIX futures are my preferred proxy, but if for those of you that don't trade futures, I gave you this setup here. This is VIXY, tracks the short-term VIX futures, and this is the setup here. Once it clearly takes out this trend line, there's your first objective entry. And then R2, these means resistance. Resistance 1 is this primary downtrend line. Resistance 2 would be a break of the 34-ish level right there. And then again, maybe it doesn't happen. Maybe we do have a blow off top. If we have a blow off top, the VIX isn't going to do this or any of this. It's probably not even going to make it up to that first target. However, if it does, the upside potential, let's just play a game that we go up here to T4. That's an 80% return, and just as in the ETF, you're going to most likely have a better return in the futures. Speaking of those, this is what the chart, I believe this is the one I gave you. I might have used a daily chart. This is 6-month, 2-hour candle. And there's our primary downtrend line. We've cracked it, but not impulsively. As I said, when you see a breakout, you want to see a breakout occur on impulsive price action above average volume. Either way, the setup is there. We just now have a little minor trend line. It has technically broken out. And I think on VIXY, it's a hair above. But I always say, you've heard me say this, if you have to squint, give it the benefit of the doubt. So this level right here would most likely start to spark some selling and would most likely coincide with a rejection off that trend line that we're backtesting on the SPY 60-minute chart I just gave you there. And that would take you up there. You can see the near-term targets on VIX futures, symbol VIX. And let me try to measure it for you here. Grab this trend line. Again, it may or may not play out. If it does play out, it's all about RR, risk-reward ratio. 90% profit potential up to that 33.16-ish target. And so, again, maybe you're not targeting that. If you are targeting that, you could give yourself a 30% downside, still give yourself a nice 3-to-1 RR. However, I don't think you need that, because if we drop much lower, if this market can't break down soon and give us some sell signals, we could see the VIX break that uptrend line. And then I can tell you this, most likely with a blow-off top scenario in the market, the VIX will come down to this. This is the extreme low. You have to almost go to a weekly chart to see it. The VIX, this is my weekly chart here. It's had some unusual, rare, extreme lows in the past several decades. This was the financial crisis back here, right there, leading up just before it started. And right there, that's 07. There's 2018. We had a big drop in the fourth quarter there. But for the most part, you can see, other than these brief periods where you drop down, this area here where we just came off of, I have two lines about 1023 and 1150. This tends to contain, it's the low end of the range in the VIX. So that's what I'm talking about. We have minimal downside, but that is a level. If we have a blow off top, you're probably going to come down to that level, maybe even hit this extreme low. So you need to factor that in, into your positions, and that would be, I mean, if we hit the extreme, all-time lows the VIX has ever hit, then you're talking almost 45%. So you don't want to let it go that much. That's what I'm talking about. Not really focusing on so much an RR, but just what the market does. Is if the market doesn't break down, if it burns through the current divergences, and there's your uptrend line. So you have a previous reaction low somewhere in there. So that would give the VIX about 20% downside. You could give it on a stop. And again, these are long-term targets. So you're looking at maybe a 20% drawdown, but about a 270% run. And guys, that's not even my long-term target. Longer term, I do think, as I've said, the VIX will hit this level within the next year or so. That's where bear markets, this is the bear market territory. And we're probably looking at the, let's make up an acronym, MOBM, mother of all bear markets, coming. And so it would be very reasonable based on the long term, the macros outlook, both the charts on the long term, of the market. We'll do SPX just for kicks and giggles, because we can go back as long as we want here. We'll go back to a monthly chart, and you can see this is the S&P 500. This is the side with the bear markets that we had in inflationary periods back in the 60s and 70s, big drawdowns, just back-to-back bear markets. And then this is where, as I talked about right here, was a will go down in history as one of the most, bullish inflection points. And it's simple. And again, I've covered this so many times, but it bears repeating for new subscribers. It's all about, if you have to wonder, where, my longer term outlook can diverge from so many economists and market technicians. It's this, and it's simple stuff. And this is, again, these are immutable factors in the financial markets, rising interest rates. So this was the inflationary period. It only picks up here. The 30-year bond, 10 years is going to look very similar. And that's where runaway inflation peaked. Chair Fedman Volcker broke the back of inflation with just aggressive rate cuts. And we started a new Goldilocks period for the stock market of a secular bearish trend in interest rates, falling rates, which again are very simple and simple math. It's bullish for economic reasons. Lower cost of capital spurs growth, and it's also bullish because the alternatives, when pension funds and hedge funds and insurance companies and even grandma and maybe even you and me, when we can lock in 10, 12, even 16% on Treasury bonds, we're going to take money out of the stock market. They will, institutions will, money will move. And the Fed even knows it and has explicitly outright said it, and going back from Bernanke and others, and that's why they lower rates. But once they lose control, again, everything is cyclical, and they just took advantage of the low inflation to keep rates artificially low for too low for too long. And so, again, I've said it by every metric that I can come up with in technical analysis, both the primary secular downtrend line, price channel being broken out of, rates going down to the floor. There was really no more downside from there. And then, of course, more recently, and the classical or standard definition of an uptrend is higher highs and higher lows. And that's what interest rates have done. So by every metric that I know in charting, technical analysis, interest rates have bottomed and most likely begun a new secular bull market. But again, we're talking decades here, guys. And I've told you this, that I can see the potential that we come in maybe, worst case scenario for rates. Again, I'm just speaking this chart, not talking about the economy or anything. We come down and backtest that. And that, as I've said, can either be, now we don't have to do that. God forbid, God help the markets if we break out of this recent high-level consolidation range, similar to what gold just broke out of. And we get these rates, you will see crash-like scenario in the markets if that happens anytime soon, especially because the markets are now clamoring for lower rates. And we're talking about the Fed rate cuts. But again, the Fed doesn't control long-term rates. Long-term rates do their own thing. They're determined by market forces. So again, more of my prediction goes out many years, not, short term. We're going to even dive down to the Treasury. So it was an objective long today on the 10 and 30-year bond. I'll get to that in a second. So I'm watching this very closely. And so far, like I said, it's been a correction more in time, right, than in price. I always say prices can correct after a big run-up. You can correct in one of two ways. You can correct in price. That's what most people think of correction. But you can also correct in time. And correction in time is the more bullish of the two. So we're going to watch this closely. And again, when I speak of this, please, please, please hear my words. I'm not talking today, tomorrow, next week. I'm talking out, going out years, the longer term outlook for rates. And if something changes, I can tell you it can't change anytime soon in the next few days or weeks. This outlook, would take months to change. But as of now, that's what it looks like. Now, let's zoom down to the daily charts and talk again what we talked about here. This is where the Fed, the last rate cutting cycle was a year ago, started almost a year to the day from this recent one. And this is considered widely 100% odds that this is not just a random one-off rate cut, rather the start of a new rate cutting cycle. At least that's what the markets are pricing in right now. Of course, that can change. We know the Fed's been very wrong, not just in recent years, but historically. But this was the last rate cutting cycle, started with 50 basis points, followed by two 25 basis point cuts. and it had the opposite effect on long-term rates. Fed was trying to help homeowners with runaway mortgage rates and everything else, and the bond market said, we don't want this easy money. It might reignite inflation. And so it went the other way. And as I talked about at the time, the stock market didn't take note right away. And it had plenty of room because the treasuries, remember, this is where yields peaked back here. We had come well off the highs, so the stock market was rallying. It was only about to this point, towards the end of the year, right here, where it started to realize something is wrong. If the Fed keeps cutting and long-term rates keep going up, that's not helping the economy, or won't be helpful. And boom. So where I'm going is, so far it's been a repeat of the same, but again, it's very, very early, small scale, but we've seen rates go nowhere but up since the Fed started cutting. Now, the difference between this time around and back here, we're starting from a much, much higher level. So again, right now, no red flags, maybe a little bit of a yellow flag since the Fed cut rate, the facts that they cut rates, the fact that the long-term rates have gone up and not down. Again, the down was priced in advance of the first cut. I talked about that, just like it was here. So, but the starting point right now, the margin of error is much, much, much lower right now to go up. What I'm talking about is this number here, about a 5.5, 5.1, 5.15 yield on the 30-year. That would break us out to not just a new 52-week high, but as I've talked about, you have to go back literally decades. You could break out, if yields break above here, you're going to see interest rates back to where they were in the late 90s and in the 2007, leading up right before the financial crisis. So those are, if you want to know the risk, and it's not a little risk to me, it's a colossal risk. So we're at a market that's priced right now. We know what's going on. It's got a very bullish feel, bullish bid behind it. Dips are being bought, but I've done this a long time, and this. Again, I traded through successful financial crisis, saw that coming a mile away, navigated that bear market. But the risk in this market back then, it wasn't. I mean, if you knew what was going on in the housing market, and I happened to be in a bank program, working as a brokerage for a bank-owned stock brokerage company for regional banks, actually several at the time. So I was acutely aware, also at ground zero, the housing crisis. So I was, very much aware of what was going on with the liar loans and all that good stuff, and how it wasn't being priced into CDOs. And that's what was the kind of the main thing that took down the markets back during the financial crisis. And there's always, like I always say, every market's different. Every market bottom, every market top. I'm going to jump over to let me do that right now. TLT is the 30-year bond. Somebody asked me just, was it late last week, earlier this week, my opinion on TLT, CB. Didn't have one because we had already, gave it to you as a short here for a pullback to this support level here, which we hit. That was a quick and profitable trade to get in and out of. Now we're closer to that support level. So I did want to point out, this is big support. So we rallied exactly where I'd expected, a little bounce off there. So far that bounce got sold into, and we're back there. So we're sitting above support. I also have it right on that support on ZB on the 30-year bond futures. We're very close. These are those comparable reaction highs. That was the last setup there. The bearish rising wedge on the 6. It was a breakout, first of all, which was bullish, as I mentioned. Then we had the bearish rising wedge pattern, the breakdown, pull back to perfectly tag that 115, 219 target. And so now, again, and I've told you lately, I've just sidestepped. This is just something I'm more watching, but I want to tell you that we're coming up on support. If that support, those recent highs right there, or those two reaction highs and that reaction lower taken out, then you have an uptrend line below. Beyond that, that would be very bearish. So watch those levels. If taken out, bonds, quote unquote, with my little air quotes, should rally. But when I do that, it means I'm a bit skeptical, or at least not so convinced that they will. more so that if they don't, and they do this, that means long-term yields are going up. The market's going to start to realize, and again, as I just showed you, the starting point right now, should the Fed once again have lost control of the long end of the curve, and long-term rates go up, regardless of any rate cuts or not, that's going to be more bearish again, because they have a lot less wiggle room, if you will, before getting up to multi-year or even multi-decade highs. Okay, so before we leave the markets, I want to do an update. Small caps, back testing, give that to you as an official trade idea recently with some price targets. And that was here because we broke down. This is the primary uptrend line on IWM, the small cap, Russell 2000 small cap ETFs. Nothing more than a breakdown of back test. So now we need to see rejection, which is what I suspect we'll get. And you still have the 3 price targets I gave you. And as I mentioned, if this starts to play out and you get down here, try to just for 1 second imagine. Again, let's just go with this. Let's just say I'm right on this call. We go down here and we get to T3. That's going to be a 12% drop. A lot of people, I can just tell you from doing this for a long time, a lot of retail, what we call, no offense, dumb money, retail investors they didn't want to buy back here, in April lows when we were covering all our shorts and buying, going long, full long. They've been wanting to buy here. We know that. We can see a lot of money coming into the market, and we know that institutions usually aren't chasing a rally at this stage. It's a FOMO rally, fear of missing out. So my point is that if we do happen to get down there and come back to those 200, it's going to wipe out and put a lot of folks underwater that have bought. And so again, just something to watch. But from I'm just talking pure technicals, breakdown, back tests, and that's an objective short inch or add-on if you took this trade. My stops remain here above on a daily close above 250, 250. And that's it. So you've got the levels to watch. You have QQQ right on the wedge, and SPY or IWM, the smallies, already breaking down and back testing. Oh, and again, remember, of all the stocks out there, the smallies are most sensitive to rising rates. So if you are in that IWM trade, whether you're long or short, bullish, bearish, watch Treasury bonds, because as I said, they don't. Remember, small cap companies aren't borrowing at the federal funds rate. Powell doesn't cut rates and say, okay, you can borrow at 3.5 or whatever they bring the Fed funds rate down to. If you're a small cap company, no, you borrow at market rates. Those are going to be pegged on. Typically small caps are rolling about 5-7 years, so you could the 10-year bond, but even the long bond is going to affect companies. All right, let's look at the other stuff. I won't spend much time here. I just got this post out to you. This is that Comcast. On the 60-minute chart, that gets you in the quickest if you're an active trader, although you have a greater chance of a whipsaw, meaning a false breakout, if you don't get a solid 60-minute close, even better a daily close, obviously even better a weekly close above a downtrend line. The problem with a weekly close is, my breakouts, the trade setups I post are usually pretty explosive, especially bottoming plays and bullish falling wedges and the likes. And so they tend to move pretty quick. So you rarely will you hear me say wait for a weekly close for a buy signal. Sell signals, if you're trading on a weekly time frame. So again, it's just one of many and long lines of blue chip. My MO lately, it's been bottoming plays, long-term companies, blue chip type companies, well-established companies at long-term support, and that's what Comcast is. Now, I did mention in that post, it's up to you. You only have about 3 weeks until they report. So companies will often, if it breaks out, I don't expect it to rip, because companies go into somewhat of a holding pattern. Usually, most people don't want to take a big position or do a whole lot right in front of earnings. So keep that in mind, that if you take this one, you will probably, if you're holding out for the upper targets, It certainly could hit, before earnings, the shallow targets. But if you're holding out for the deeper targets, you most likely are going to have to ride that one into earnings. So I'll let that be your decision if you take it, or if you decide to hold it. Gold, we're still waiting for the trend line break. Gold still remains in an uptrend. This is that trend line I told you that we have to break down to get a sell signal, to get any traction on short trades for gold, silver, or GDX. And so we're comfortably above it right now. So GDX broke down and back tested the wedge I gave you a week ago, but as I told you, it's not going to go. It's only going to go so far. So there was a breakdown, back test, rejection. Still have two targets, but it's possible but unlikely that we're going to get down to this second target, which is another 13%, unless gold breaks down. Again, certainly possible, just unlikely. Haven't been updating crypto much, but we had a sell signal today, so I'm going to show you that. This is my 60-minute chart of IBIT. There's a lot of ETFs out there. This is the one I've been using, very liquid. It's iShares. A lot of folks buy iShares. We've had longs and shorts on this. We were shorted Bitcoin back here. We were coming up on my fourth target, but that was the April lows where it's stated covering every short, all shorts going full long. And so again, there were a lot of what I call truncated trades that I think will ultimately play out back down to those deeper targets. But we reversed that. We went long. We had micro strategy, one of the Bitcoin proxies, and they're all going to move together. I just want to point out that we have come full circle with the divergent high. We had a divergent high there, and we had a correction. We had a divergent high here. We had a correction. So we're inching higher. It is a complete risk-on asset right now. We know the markets are in risk-on mode. So I just want to point out, however, a sell signal is a sell signal. It comes after a divergent high. Here's what it looks like on the daily chart right there. Big divergent high. So kind of what I see in the charts. I mean, the uptrend's powerful. There's the breakdown there. Let me give you Bitcoin. Let me give you the actual crypto. I've got a chart on that somewhere here. These are futures, BRR. Right there is the divergence line. You can see we had a little small divergent high there. It was actually from here to here, right there. You can see it on the charts. That divergent high gave us a nice double-digit drop there in Bitcoin. Put in another divergent high right there, a little wedge, another correction, and it's been kind of moving around in this toppy-ish range, topping type range. And most recently, again, this is a sell signal I'm giving you right now today. So we are on a sell signal. It was a nice, clean uptrend line. This chart's 2-hour candles, 6 months of price history. Where to? You can see I don't have anything really much. There's a little bit minor support right about there. I can see a few reaction highs. I'll give that level to you about, give or take. Although I like it to down there. Plus, I think, like I said, this is the week I think the market will start to reverse and give us those sell signals on QQQ. All right, so there's one more I wanted to show you, and that is this one. This is the, where'd it go? BTC. No, that's CB. Where did it go? BRR. Sorry, guys, I have it somewhere down here. I have a lot of charts. Okay, this is it. BTC. This is the actual Bitcoin crypto you can buy on the Paxos exchange or wherever you want it. There is just a beautiful uptrend line. That's uptrend line comes off the late November 2022 lows. This is what it looks like from a long-term perspective. We had a nice divergent high there. We had a very nice correction. Took us down to that trend line there. That's where I just showed you was that it? Yeah, into the March. Yeah, that was it. And into the April lows. And yeah, that was the correction. Bounced up, extended. So the divergences continue to grow. And I'm hearing just so many Johnny-come-lately analysts coming out of the woodwork now saying crypto and gold and everything is just going to keep going up, and you want to buy them because right now even though the stock market's strong, It's a fear that we're debasing the dollar and that's the only way out. I agree, but remember, talked about that. It's a race for the bottom in the dollar. And so Japan just had a new PM that's a dove. So there'll be, money printing over there and cutting rates most likely. And that's the yen's the second largest component in the dollar index behind the euro. So yes, there's no question in my mind that the only way out of our spiraling debt, deficit spending, and the fact that the Trump administration, although they, certainly differ on where to spend from the previous administration, they are an administration of spend, spend, spend. So, and also deflate the dollar and keep the gun financial assets up. So, okay, I get that fundamental argument. And if you want to invest on fundamentals, follow Warren Buffett's lead. He's a fundamental analyst. And buy something and hold it for 5-10 years and diversify. Those are his rules. But also his rule number one, don't lose money. Rule number two, don't forget rule number one, right? So, if you believe Bitcoin's going up to the moon, then just set your stop appropriately. What I see, there's that little, again, I'm on a 3-year chart, daily candles now, but this is that little trend line right there I just gave you. Here, I'll drop it down so you can see. And that just broke down. So we'll go down to 2-month chart, hourly candles. There's the breakdown right now. I can probably put a benefit of the doubt, what I call BOD trend line here, which I might as well do now. You've got a couple reactions there. Either way, so it looks like Bitcoin could be correcting. And then, man, I could go on all day. There's a lot I'm watching, but the Bitcoin proxies, I call them. I'm going to just rifle through my watch list and show you some of these. That's just Grayscale Bitcoin Trust. We used to trade that. That was the first to market ETF-like instrument. It's not technically an ETF. It's more like a closed-end fund, but there's some levels there. But the big proxies that you're going to have a lot of meat on the bone if Bitcoin truly rolls over and this breakdown sticks is this one here, Riot. Oh, nice looking setup. It's coming off its previous all-time highs. Looks just like this, divergent high, just like a divergent high there. Let me just measure these drops. And again, this is a swing trade, just like Bitcoin. I don't believe in it per se. I know what it is, and it doesn't matter to me. I don't care if it's the currency of smug, like Charlie Munger says, the currency of smugglers and drug dealers and traffickers. I'll trade any security long, short, just based on the charts. And, crypto and the crypto-like proxies like Riot, they just trade so friggin' well to the technicals. We've had a lot of trades on this divergent high, divergent low, rally. Let me just measure these trends for you. That's that divergent low, 546%. From there, it dropped about 60%. Another divergent high, it dropped down about 70%. Divergent low, it rallied up. The initial rally was about 150%. Put in a second at that same support level, another divergent low, bullish falling wedge. Remember, divergence isn't a buy signal. What's objective long entry is along its support or along on a breakout of a bullish chart pattern like that. Bullish falling wedge. We hit, we took it then. T1, T2, T3. That was from, remember, we covered everything here, covered all shorts, so flipped around. This was the one I gave you, I guess, as a proxy to trade it then. Now we've come full circle. We've got a divergent high right now. Nice little wedge. If crypto breaks down, then where to? Minimum, this trend line. Even a correction would take you back to the trend line. That's going to be about a 25% drop. Or maybe a bigger trend change, just like that trend change there, which, had smaller trends within it. But before all is said and done, this was the larger trend. Downtrend is lower lows and lower highs till the bottom there. All right, in there too, there's other ones, Hive. All these are looking ripe. Again, if Bitcoin rolls over here, I just want to point that out. So if you want to take a shot, set your stops appropriately. But these are the, again, in my folder of crypto proxies, and they're all starting to set up, coming full circle again, following these divergent lows and rallies. That was a divergent low there, and now we have a divergent high, and some of these at resistance, not all of them. CME, I have this in there just because they tend to, and CBOE, with futures and all that on there. ETCG, Ethereum broke down from that wedge. ETHE, the Grayscale Ethereum Trust. You can see here I put a divergent high too, only because if it gets an equal or marginal new high, it'll still be a divergent high, just a much bigger divergent high than that previous divergent high, which was a drop of about 22%. So logic would stand to reason that it's going to be even a bigger drop if it comes. And then there's your primary uptrend line if you're trading Ethereum. And nice and clean too. There's your low in April. Oh yeah, we went long this one as well. You know, milk the easy money on that, and now it's starting to look like setting up for the next short trade. Litecoin, Mara, Coinbase. I've got a bunch of them in here, guys. I'll probably have to do a separate video to cover everything in that sector. Before I wrap up, the one of the things I continue to watch, as you know, and I've thrown it out there that I believe it may be the next shoe to drop. See, that's the problem. You know, if you do this long enough, you know that every market cycle, the bubbles are different. Now, the latest, you know, soundbite is, oh yeah, it looks like 1999 with AI, feels like it, but that the difference is the dot-coms weren't making any money and they didn't have a business model. Well, same story. Again, we all know now, and it's starting to be well documented. I talked about it before, this whole circle jerk, if you I call it circle jerk, but positive feedback loop of, you know, NVIDIA, AI, the big tech companies spending, giving NVIDIA insane amounts of profits, NVIDIA turning around, investing in OpenAI, who's now turned around and invested in AMD. And it's all, again, as the money flows are, you know, right now they're circular. When that trend reverses, when it reverses, the main, the obvious knife that's going to, you know, put it, you know, kill the whole bubble in AI will be the big companies cutting back, reversing their flows on CapEx spending. And so when that happens, it goes the other way. They cut back, NVIDIA then cuts back and goes down. And either way, right now, this is the one I'm watching. And I did I used Perplexity to search to see what percentage of spending. Here, let me show you. See, the problem with private credit is the first word there, private, meaning these companies don't have the public disclosure and reporting requirements that publicly traded companies do, both private equity and private credit. So you guys know I've been eyeing private credit as one of the potential shoes to drop. And so I was looking at their exposure to AI and all it, you know, and again, you're not going to get exact figures because they don't have to report and disclose that that much, but it's huge. It's very large, and it's been increasing rapidly. They're talking about how rapidly it's been growing, lending that is, from private credit funding for AI development, and so it's pretty big. I just wanted to point that out, and because something is going on here. I've been saying it, and you know, I watched, it's funny, I read an article where someone recently acknowledged, hey, what's going on with the private credit income, but they spun it as bullish. And they said, oh, well, it's just a little adjustment because a lot of these loans are variable rate loans, right? So with the Fed cutting rates, it's to be expected, a little profit taken there. Well, okay, let's talk about that. When was the last Fed rate cutting cycle? So we just started one this month, or last month in September. And last year we started here, and we had 2 additional follow-up cuts. Well, guess what? It didn't matter back then. Private credit, BIZD, which are the business development companies doing private credit, it went up. Something else is happening now. So these guys, as I mentioned, this was a level I gave you where that would be the breakdown of the sector. You know, to me, a significant level, 1574. We hit my first target. We bounced back to that 1574 key support. Then we took out T1, we went to T2 as expected, floundered around on it for a couple days, maybe a week or so, took it out, hit T3, but gapped down below it. Remember, support, once broken, becomes resistance. In this case, we gapped down below it, went back up. Look at this. 1, 2, 3, successful back tests from below of that broken support, now resistance level, and now rejection. So okay, maybe I'm looking at something that doesn't matter. We'll see. I just want to point this out, that this sector continues to go down. And I believe that there's most likely unwinding in there. And I think and remember, I started focus on this when Tricolor, that auto lender that was cooking the books, loaning, giving car loans to people that had absolutely no credit. They were targeting, undocumented immigrants. Yeah, that's a great business model. So anyways, so they went belly up. And when that happens, guys, it's not just Tricolor. We know where the losses were. We know Fifth Third, and I think it was Citigroup, maybe one of the big banks. So Fifth Third Bank, who were short. We just hit our first target yesterday. Another one, we know that they will take the bulk of the hit. But what happens then is other things. That sometimes that's a catalyst that triggers events within the financial markets, and so we'll see where it goes. And all I can tell you is something's happening here that is not really showing up elsewhere. I watch credit spreads between junk bonds, and those are, remember, credit spreads are on publicly traded bonds from publicly traded companies. Those are usually corporate bonds, and they're ready. I've been showing you JNK is sitting right on a trend line, and LQD. There's JNK junk bond ETF. A nice negative, big negative divergence. Last time I had a divergent high was right here. That was a divergent high. There was a sell signal, and junk bonds fell 6%. Doesn't sound like a lot. That's huge for a bond fund. That wiped out years of interest payments on the ETF in a matter of just weeks there, or months. And then HYG is the other widely held junk bond ETF right there. It's starting to crack right now, again below the trend line, coming off a big divergent high. And so when this finally starts to go down, the question is it going to be falling more than treasuries? And I believe so. And that's when credit spreads widen. If junk bonds fall lockstep with treasury bonds, and you're keeping credit spreads where they are right now, we know they're historically very low, very tight. This market is not pricing in hardly any risk. It's gotten to the point where it's bulletproof. And I think that's a function. It's a function of everything in recent years. The Fed bailing out every time the market sneezed. The Fed would just explode with liquidity, rate cuts, or quantitative easing, or whatever backstopping they could do. Things from shenanigans from the Treasury. So it takes years of that. But now we finally reach a stage where investors seem completely confident that there's not a single shock or issue that's going to take the markets down. And so I'm watching that. When you start to see, that's been the one shoe that hasn't dropped yet, a significant widening in credit spreads. So I'm going to watch that, see if these junk bonds, remember, bond price is what I'm talking about here. The price of when they fall, rates go up. And then the other one too is investment grade corporates. I very, very much watch those as well. If you're not familiar with this, a lot of the issuance in recent years has been on the lower end of the credit quality spectrum. So when you go down and you start getting knocked down from triple B rated, where a lot of this issuance has been down to the single Bs and double and single B rated, you have an unwind here that could be pretty rapid, because these fund managers that and there's a lot of them, they're in your 401k, that say they can only hold investment grade bonds. They have to then start selling those bonds as they get downgraded into junk status, which is below that triple B rating. So I'm watching all these things, guys, and right now we're walking the line, just like the stock market. But like I said, I'm seeing some cracks in private equity, maybe a buying opportunity. I probably should cover it in another video, because I can tell you right now, as much as I've been focused on that as somewhere where there might be problems. I also have a lot of these private equity companies, I'm going to rifle through them, are coming up on pretty good support levels. But they're also in pretty much free fall mode, so be careful about trying to catch that falling knife. There's a bunch of them. Look at FSK, FSKKR Capital just in free fall mode. And so you have to ask yourself, what's going on there? Okay, wrap it up here. So those are the things I'm seeing now. Crypto breaking down, triggering some sell signals. A lot of those crypto proxies looking ripe for either at least corrections, if not possible trend reversals. And again, most likely, not absolutely, but most likely that's going to entail the market, the equity market, stock market rolling over, because there's this huge risk on correlation right now. So we'll see. I'm going to wrap it up here, and just want to say I still like natural gas. That's, had its little correction off T1. That's why I list multiple targets, pull back, and so we just need to pop T1, rally on, and then open the door to these other levels there. And but again, we need to take out that $14 level now. All right, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.